In the U.S., credit card debt is one of the easiest to accumulate due to high interest rates and quick access to credit. Many people start with a simple, unplanned purchase, and when the bill arrives, they opt to pay only the minimum amount. It seems like a safe choice, right? But in reality, this can be the start of a vicious cycle. Credit cards in the U.S. often have interest rates ranging from 15% to 30% per year, depending on your credit history and the card issuer. This means your debt can quickly grow out of control, and before you know it, your balance becomes overwhelming. Let's analyze a practical example. Suppose you have a credit card debt of $5,000. If you only make the minimum payment, which is usually around 2% to 3% of the balance, you'd be paying between $100 and $150 per month. Seems manageable, right? But here's the catch: at a 20% interest rate, most of your payment goes toward paying off the interest rather than the principal. Over time, your debt doesn't decrease much. Instead, the balance stays high, and you keep paying mostly for the interest. If you only make the minimum payment for a year, you could end up paying over $6,500 in total, even though you started with just $5,000. That's the danger of relying on minimum payments, and unfortunately, it's a cycle that many Americans find themselves trapped in. Why is credit card debt such a common problem? In the U.S., credit cards are incredibly convenient and widely accepted. But they also create a false sense of financial security. When you can swipe a card and buy something without thinking about paying for it up front, it feels like you have extra money available. Many people aren't taught about the consequences of interest rates and minimum payments. Young adults, in particular, get their first credit card without realizing how quickly debt can accumulate if not managed carefully. On top of that, consumer culture in the U.S. is very strong. With easy access to credit, it's tempting to buy the newest phone, travel, or dine out frequently, often without considering the long-term financial impact. Credit cards offer a quick fix for instant gratification. Credit card debt affects much more than just finances. Many people experience constant anxiety and stress due to concerns about making payments. This financial pressure can harm relationships, lower quality of life, and prevent future planning. Additionally, this debt can delay important financial goals, such as buying a home, saving for retirement, or investing in children's education. If not controlled, it can become a major obstacle to achieving financial stability. Now that we understand the nature of credit card debt and why it's so common in the U.S., we can start taking steps to get out of this situation. In the next lessons, we'll explore the best strategies for paying off your debt, along with tips for managing your finances more effectively. The key is to act now. Don't wait until your debt becomes unmanageable. There's always a way out, and I'm here to guide you on the path to financial recovery. Practical tips for people in debt. Always pay more than the minimum to reduce interest costs and pay off your balance faster. Avoid using your credit card for new purchases until your debt is under control. Review your expenses, cut unnecessary spending, and use that money to pay off your debt faster.